Hello and welcome to Options in Plain English. Today we're going to start talking about option strategies where we combine positions on the upside and on the downside. The first strategies we're going to look at are two of the strategies that beginner traders often use when they start looking at delta neutral positions and how to take advantage of option properties that are not related to a directional outlook. I'm talking about Strangles and Iron Condors. Strangles are undefined risk positions that take advantage of time decay and implied volatility's mean reversion without necessarily having a directional component to them. Iron Condors are similar but define the risk and max loss by working with short spreads instead of short naked options. In this lesson, we'll look at their structure, advantages and disadvantages, and how to initiate and manage Strangles and Iron Condors. We will also determine the market conditions that make these strategies a good fit for your overall portfolio. So we're going to start by looking at a short put. We know what a short put is. A short put is a position that's made up of selling a put at a certain strike price. And we also have a short call. We already know these positions. And the short call, you take a call and you sell it at a certain strike price. Of course, these strategies are naked options, so they are undefined, they have unlimited risk. And what will happen if you put them together? Well, if you were to sell a put that's out of the money and sell a call that's out of the money as well, simultaneously, you would have a position that's called a strangle. So a strangle is made up of a short out of the money put here and a short out of the money call here. This is where the price is right now. So both these options are out of the money. If you wait and these options expire worthless, then you're going to keep the original credit in its entirety. And that's what you want the market to do in this particular position. What you want is nothing to happen. The price not to move a lot. You want the price to stay inside this range, and you want time to pass so that these premiums here for both put and call start going down, and you start making money by having a position where you have to buy to close those options. Okay. The max profit for this strategy is the credit that you received. The credit that you receive is made up of the credit for the put and the credit for the call. So put plus call. The max loss is unlimited. Why is it unlimited? Well, on the downside, you could lose a lot of money because the price can go to zero, and then this put is going to start having a higher and higher value that you need to buy to close. Because of this, you have what's called unlimited risk. Even though it's bound by zero on the downside, it's still a significant, usually it's still a significant amount. On the upside, it is truly unlimited because the stock or the underlying can go arbitrarily higher and higher. So there is actually no limit on the upside to how high the stock can go to and how much money you can lose. Because of this is said to be an unlimited position or an undefined risk position. Now the break-evens are going to be, because you receive the credit, which is equal to the put, to the call, to the put and the call put together, you're going to have two break-evens. You're going to have one on the upside and one on the downside. The one on the downside is going to be the strike price where the put is minus the credit that you received, because your profits are going to start going down as the price goes lower, and then the price hits a point at which the whole trade becomes a losing trade, and that point is the break even. On the upside is something similar. You have the call, and you have the credit that you received, and the break even number two. The other break even is going to be the strike price where the call is plus the credit that you received. at this point and higher at expiration, you're going to start having losses. Now, it's important to notice here that you have a dashed line here. This is the solid line is what's going to happen at expiration. But prior to that, you have a P&L that's going to be similar to this dashed line. And in this line, this curve is going to start going higher and higher until at expiration it's going to merge with the solid expiration line, expiration P&L line. So prior to this, you're going to start seeing profits. Some people, when they trade, when they use this strategy, what they do is because you have your profits are not unlimited, so you're not going to be making money and then more money and then more money. What's going to happen is you have a profit that's predefined as max profit. What they do is they look at a certain percentage of that max profit and they close the position and remove the risk of the price going higher or lower violently, and then creating losses by taking this off at a certain percentage of max profit. That's up to you, and that's something that that's going to have to be a part of your trading plan. Now let's talk about a short put spread being put together with a short call spread on this side. If you sell a put spread that's out of the money and you sell a call spread that's out of the money as well, and you do this simultaneously, what you're going to have is an Iron Condor, which is a very similar position to a Strangle. In fact, it is the same position with an added long put on the downside and with an added long call on the upside. Why do we buy these options, this call and this put? Well, the reason why an Iron Condor uses a long put and a long call here is because you want to limit your losses. So once the price starts getting to this point, this long put is going to start kicking in and you're going to limit the losses, because you're going to have a short that's going to give you losses and you're going to have a long that's going to equally give you profits. So they're going to offset and you're going to have a constant net level of losses here. Same with the calls. You have a short call here and you're going to start losing money, but then when this call starts kicking in, your losses are going to be capped, and this is why you buy this. Now, in exchange for that, you have to pay for this, and of course your max profit is going to be less than the max profit that you get from a Strangle, all the other conditions being the same, because you have to buy this. Along with this Strangle, when you start as time starts passing, is going to start making money at a very high rate, because the time decay, which is a Greek that we haven't seen yet, but it's called theta, is very elevated here, and it's going to start making money as the price is stuck inside this range. In the case of an Iron Condor, because you have both shorts and longs on both sides, those Greeks are not as big because you are offsetting them with their long counterparts, even though they are at a higher strike price in the case of the call and at a lower strike price in the case of the put. They're still affecting the overall Greeks of the whole position. So a Strangle has larger Greeks overall than an Iron Condor. Now, the advantages of an Iron Condor, of course, max loss is predefined. And that's a big advantage, because also when a position starts moving against you, the buying power reduction for a Strangle is going to be a certain percentage of your notional value at the beginning. But if it starts going against you, that buying power reduction is going to start increasing. So it's not constant, it's dynamic. For an Iron Condor, no matter what happened, your max loss is going to be your buying power reduction at all times. So even if you're at a point where you're losing, your buying power reduction is not going to increase. And that's a big advantage, because that's not going to start eating away at your at your other positions and at the rest of your portfolio, because this position is static when it comes to buying power reduction. Now, an Iron Condor is made up of, like we're seeing here, but it's basically a short put spread on the downside. So short an out of the money put at K2, short and long an out of the money put at K1. And then another short spread, in this case a short out of the money call spread, one short out of the money call at K3 and long one out of the money call at K4. Another way you can look at this, and maybe this is going to confuse you, so if that's the case, just ignore this. But another way to look at this is as a short strangle and a wider long strangle. Because here you're buying the long put and you're buying the long call here. So you have a short strangle that's closer to the price, closer to the current price, closer to the at the money, and then a wider strangle that's also a little bit that's also on the same underlying and on the same expiration number of contracts, but that is a little bit further from the at the money. So if that's confusing you, just forget about that. Think about it as being short a call spread on the top and then short a put spread on the bottom. Okay, that's the structure. Max profit is going to be whatever you got for both short spreads. Okay, so PS minus PL, the premium of the one you sold minus the premium of the one you bought, and on the call side, the premium of the call that you sold minus the premium of the call that you bought. Now, the break even is going to be very visually, it's very simple to determine. It's very easy. You just take the where the strike price is and you add the credit that you received. So K2 minus the credit that you received, which is this one, the max profit. And on the upside is the same thing. You take K3, the strike price where your short call is, and you add the max profit. Okay, that's where the break evens are. The max loss is going to be, because here visually we're assuming that that both the call spread and the put spread are the same width, but it doesn't necessarily have to be the case. In fact, if we start using deltas as an indicator and as a determinant of where the options are going to be, then probably those spreads are not going to be the same width. So the max loss for the whole spread, for the whole position, is going to be the greater of K4 minus K3, so the width of this spread minus the credit received, or K2 minus K1, so this width minus the credit received. So basically what this is telling you is wherever you have the max loss is going to be where your whole position is going to be margined at, and the max loss is going to be your buying power reduction, because your broker is going to take the whole width times the number of contracts, but you're going to receive a credit that's the initial credit, so you're going to reduce the requirement for capital for this position by the credit that you receive. So in reality, the max loss is going to determine your buying power reduction, even though when you look at your broker monitoring page, or any page where it shows you your trades, is going to probably say just the width of the spread times the number of contracts. In reality, you got a credit for this, so that credit is part of your assets already. So you get to keep this credit. Okay. Now, just to summarize, both these positions want the price to stay in a certain range. They want the volatility, the implied volatility, to go down, because that's going to be increasing your profits on both sides. And they want the price to stay where it is. And in this case, you have a higher credit because you're not buying the what traders call wings, but because of that, you have unlimited risk. For the Iron Condor, you're buying the wings, and because of this, you have a limited max loss and a limited risk, which makes your buying power reduction be static, whereas this buying power reduction for the Strangle is going to be dynamic. Now let's go and take a look at an example to see how this works out. We're going to start by looking at a Strangle. So what we're going to have here is we're going to have an example of a Strangle to see how the different numbers work out in terms of break-evens and max profits and max losses, etc. So if we have an underlying, it could be a stock that's trading at $100. We're going to be selling a Strangle, and we're going to go $10 higher, $10 lower. And we're going to be selling those put and calls respectively. The put is trading at $350 and the call is trading at $350 as well. So you're going to be selling the put and selling the call. And you're going to be collecting $350 for the call and $350 for the put. So this position is referred to as the 90-110 Strangle, and you put it on for $7, which is the total credit. Your break even is going to be, if you follow the formula here, the strike price here, KP, minus the total credit. So it's going to be 90 minus 7 is going to be 83. And on the call side, your break even is going to be the strike price where you have the call plus the total credit that you received. So it's going to be 110 plus 7, 117. So you have break-even 1 being 83 and break-even 2 being 117. So it's basically where the strike prices are, and then you move further from the at-the-money price by the credit that you receive, and that's where you have your break-evens. Max profit is going to be $7. There is no way for you to make more than $7. $7 is the most you're going to make. Your max loss is unlimited because the stock price could go to 200, 300, 400, 700, 1,000, 2,000. There is no limit on the upside. You're going to be losing from this point on 1-to-1 with the opposite of the stock price. On the downside, you're going to have your break even, and the stock can go to zero. So your max loss here is going to be 83 times 100. So it's going to be $8,300, $8,300. But on the upside, the loss is unlimited. Your buying power reduction is going to be the greater buying power reduction for either side. So if you have the short call has a certain buying power reduction, we're talking about naked options here. You're selling a call and you're selling a put, and your call is going to have a certain requirement for buying power reduction, and the put is going to have that as well. Whichever is the greatest of these two is going to be the one that's going to apply for the whole position. Now, since you cannot lose on both sides, those requirements are not added up. You just take the one that's the greatest, and that's the one that you apply to the whole position. So this is something that I mentioned here. In most cases, having already a short call or a short put and adding the other side does not increase the BPR for the overall position. Because of this, it is considered a capital efficient strategy. So if you have a short call and that the buying power reduction is $10,000 or whatever, actually let's calculate. Let's get a rough estimate of this. This is going to be around 20% of the notional value, so it's going to be around $2,000. So the short call is going to be using $2,000 as a buying power reduction, and the short put is going to be using approximately the same, or maybe a little bit less because we're talking about the strike price here, and this distance is subtracted as well. So let's say that the buying power reduction for the put is going to be $1,800, so $2,000, $1,800. In that case, the buying power reduction for the whole position is going to be $2,000. It's not going to be $2,000 plus $1,800. It's not going to be $3,800 because they're not added up. You can only lose on one side at expiration. You can't lose on both sides. That's why you're only margined on the higher margin side that you have for this position. So this strategy is profitable if the underlying price stays inside the range. So if it stays inside at expiration, inside the range of the strike price for the put and the strike price for the call, then you're gonna have max profit. But if it stays inside the range bound by the break-evens, then you're gonna make money. This position is going to be profitable if the implied volatility decreases after establishing the strangle. So if you put it on and it has an implied volatility of 25%, and that implied volatility goes down to 20%, for example, you're going to make money because of that. Because in this case, the implied volatility being lower means that the probability of the price going outside of the strike price where the put is on the downside, or outside of the strike price where the call is on the upside. So basically of becoming in the money for both, or for either call or put, is going to be higher. So the probability is going to be lower if the implied volatility is lower. Because of this, the price of the call and the put is going to go lower, and then you're going to start making money. Time decay works in favor of this position. So if nothing happens and time just passes, you're going to start making money. This is something that's very appealing about this strategy. You are not betting on something happening. You're betting on something not happening. So you're betting on price not going outside of these range, or outside of these strike prices or break-evens. The max profit only happens at expiration, with both options expiring worthless. This position is directionally flexible. It could be established as a delta neutral strategy initially. So if you have a position and you sell the put here and you sell a call, and this put has 20 deltas and this call has 20 deltas as well, the short put is going to give you 20 positive deltas. The short call is going to give you 20 negative deltas. They're going to offset, and you have no delta. Now, as the price starts moving, the deltas for the call, the deltas for the put are going to change, and you're going to start having a directional position as the price starts moving, because this position wants the price to go right to the middle of the range, because that's where it's the most likely to expire worthless. But at the beginning, you can decide if you want a delta neutral strategy. If you pick the same deltas, and of course for the strangle, you have to use the same number of contracts for both put and call, same expiration. So if you want your strangle to be delta neutral, you pick the same delta for the call, the same delta for the put, and you're going to have initially a delta neutral strategy. Later on, is going to acquire some deltas because of another Greek that we haven't seen, which is called gamma. But basically, the deltas are going to change with the price change. Okay. Now, it doesn't need to be delta neutral. If you want this strategy to be a little bit directional, so for example, if you want if you think that it's not going to go higher by much, but you want to give yourself a little bit more of a cushion on the downside, then you sell a call that is closer to the at the money, and then you sell a put that is further from the at the money, and that's going to give you a delta component, because the deltas for the call are going to be higher than the deltas for the put, so your delta is going to be negative, but it's still a strangle. So, and if this price starts going to the middle, then you're going to start making money, because this is at a point in price where it's the likeliest to expire worthless. Finally, a strangle can be adjusted, rolled, and modified in many ways to take advantage of changing market conditions. Once you initialize a strangle, this is just the beginning. You can then, as the price moves, you can tighten it up, you can widen it out, you can roll it out in time, you can adjust the strikes, you can add another position, you can, for example, buy the wings and turn it into an iron condor, you can tighten it up so much that it becomes a straddle, which is another strategy that we're going to be looking at, where the strike prices are the same for the put and the call. There's many ways you can modify a strangle to take advantage of changing market conditions. Because of this, it's a very flexible strategy, and because of this, it's a strategy that a lot of traders, especially the ones that are just starting to sell options, prefer this strategy. This is a staple of premium sellers everywhere. When a trader just sees implied volatility being very high, but he or she doesn't know whether it's going to move up or down, you just initialize a strangle, take it from there. Later on, we'll adjust as needed. Okay, so a strangle is a very important position. It's a staple of premium sellers everywhere. Now we're going to take a look at an iron condor, and we're going to do this a similar example, similar to the one we did for the strangle. Okay, we have the price, the underlying price at $100, and we're going to be selling a put spread on the downside. We're going to sell the 90-80 put spread, and the price for the 90 put is $350, and the price for the 80 put is $150. On the upside, we're going to sell the 110-120 call spread, and the 110 call is trading at $350, and the 120 call is trading at $150. So the position that you have is the 80-90, 110-120 iron condor for $4. $2 from the 350 minus 150 here on this side, and another $2 from the 350 minus 150, $2 on this side. So altogether $4. The break-even one is going to be K2, in this case $90 minus the credit that you received is going to be 90 minus 4, it's going to be 86. And the break-even 2 is going to be the strike price where the short call is plus the credit that you received. So 110 plus 4. So it's going to be a total of $114. The max profit is going to be $4, which is the credit that we received. And the max loss is going to be $6 because the width on this side is 10 and the width on this side is 10. So the greater of is going to be actually either one of them. And it's going to be $10 minus 4. So the max loss is going to be $6. Very different than the other one. When we had a strangle, we had a max loss that was unlimited. So the buying power reduction was going to be maybe $2,000. In this case, it's going to be $600 per contract because that's the max loss that we can have on either side. The buying power reduction is going to be the greater, again, the same, the greater BPR for either side spread, considering the full credit received. In most cases, having already a short call spread or a short put spread and adding the other side does not increase the BPR for the overall position. So if you already have a short call spread and you are required to put down $6 in this case, for example, or $8, let's say you're only selling the call spread, then you're going to be getting $2 and risking $8. So you have to put down the $8. Actually, altogether, you're going to see a requirement of 10 minus the credit that you received. You know that the actual requirement is actually 8. But in this case, if you sell the other side, then you're going to receive an additional $2, and you're not going to put down any more money because the price can only at expiration be either on the upside or on the downside, but you can't lose on both. Because of this, It's perhaps a good idea to think about selling both sides when you initialize a position, or if you already have a position, to think about selling the other side. An Iron Condor is profitable if the underlying price stays inside the range. So same thing as a Strangle. It's going to be profitable if the IV decreases after establishing the Iron Condor. However, those profits are going to be less than the ones for the Strangle. Why? Because even though IV decreasing is going to be beneficial to the position, you have both sides of the coin. You have short options that are benefiting from IV going down, and you have long options that are also affected, and these are going to be affected. They're going to be hurt by IV going down. So it's a combination of both that's going to affect your overall position. Because of this, and an Iron Condor does not benefit as much as a Strangle from IV going down. Same with theta, same with time decay. Time decay works in favor of this position, but to a lesser extent than it does for the Strangle. Why? Because again, you have short options that are benefiting from it, but you have long options that are being hurt by time decay. So overall, because these ones are closer to the at the money, they are going to benefit more than the ones on the wings are going to be hurt by. So overall, it is a something that's beneficial, but it's less so than it is for the Strangle. Max profits are only going to happen at expiration, with both spreads expiring worthless. And this position is directionally flexible. So again, same thing as a Strangle. It depends on where you position your shorts and your longs, and altogether, that's going to determine what the delta for this position is, and delta determines the directional component of your position. In this case, you're going to have to get the delta for this, delta for this, delta for this, and delta for this, add them all up, because you have the same expiration, same number of contracts. You straight up add them up, and you get the position delta, and that's what you have. And when you are building your portfolio, that's what your directional risk or your directional component is to this position. An Iron Condor is less adjustable than a Strangle. So we mentioned when we talked about the Strangle that we can, once we initiate it, we can adjust, we can roll, we can add to the position, we can roll it out in time, you can adjust the strikes, you can tighten it up, you can widen it out. It doesn't matter what you want to do, you can do it with a Strangle. With an Iron Condor, you can do it as well, but for example, if you decide to move to adjust this strike and bring it closer to the at the money, for example, let's say the price moved in this direction, so you want to take advantage of this, and then you want to move it so that it's still the same distance, or if we're not talking about the distance in dollars, we're talking about distance in deltas. You want to move it over here. By doing so, you're going to be widening out the spread on the upside, so you're going to require more funds for the buying power reduction on this side. And remember, the greater requirement is the one that's going to drive the requirement for the whole position. Okay, so because of this, it's not as simple as just move this short call over here. You would have to bring your long with you over here as well. So now it's two things that you need to move, the short call and the long call. And by moving the long call, by moving the short call closer to the at the money, for example, you're going to be getting a credit. But by moving the long call closer to the at the money as well, you're going to have to pay a debit. So whereas this adjustment would bring a credit, if you're talking about a Strangle, with an Iron Condor, it's still going to bring a credit, but now the credit is going to be less because you're moving two legs. Or you're just moving this one, and you have now more risk on the upside. So It's not as flexible as a strangle just because it has more components. Also, you have to when you're starting to adjust and you start rolling positions out and making any type of modification, you're going to have transactions. So you're going to have to issue a transaction, an order, and those orders are going to go through the bid-ask spread. And if you are taking as a cost of doing business the bid-ask spread for this short call, when you sell it and when you buy it, now you have to add the bid-ask for the long leg as well. So those costs add up. I'm not saying it's impossible, it's just less simple and less easy. So many traders, what they do is they put on an iron condor and they leave it on like that and then wait for expiration to see what happens. That's one approach, not to do any adjustment because it's so cumbersome to perform these adjustments on two legs. If you wanna adjust one side, or let's say you want to roll it out to the next month, you have to close the whole iron condor for individual legs and then reopen them on the next month, another 4 legs. So it's 8 times that you go through the bid-ask spread, and that's going to become a greater amount for slippage, and slippage, of course, hurts your results and your returns at the end of the day. So now we're going to go to the platform and we're going to take a look at some examples with real data so that you can see this in action and you can get a feel for what it is that a strangle and an iron condor are. So now we're here on our platform, and what we're going to do is we're going to use Netflix. NFLX is a ticker symbol. It's trading at $426. We're going to open up the June 2020 expiration. It's got 17 days to go, 17 days to expiration. And what we're going to do is we're going to be selling a strangle, and then we're going to sell an iron condor. Okay, so let's say we decide that we want to sell the a strangle, and we're going to use the 30 delta. So we're going to go to the right now it's 425.95. We're going to go to the 410 put, and also the 450 call. Okay, so 450, 410, this is the strangle. We're going to sell it. We're going to be receiving a credit of 1225. So altogether, we're talking about a credit of $1,225. So if we go here, you can see the you're selling a strangle Netflix, June 2020, 450, 410, call and put at 1225 to open. Okay, your break evens are going to be the strike price on the downside, so 410 minus the credit received, and on the upside the strike price plus the credit received. So 397.75, 462.25, max profit 12.25. The buying power effect is going to be around $7,000, 6,900. What we're going to do is we're going to take this trade and we're going to send it to the Analyze tab, Analyze Trade, and we'll go here to the Analyze tab, Risk Profile. Okay, we're going to remove these ones, and we're going to put it away for a little bit. We're going to do the Iron Condor as well. So what we're going to do here is we're going to change this triangle. We're going to use the same short options, but we're going to add wings. So what I'm going to do is I'm going to make this, I'm going to turn this strangle into an Iron Condor by adding wings. And I want to make it $20 wide. So I'm going to be, since I have the 410 short put, I'm going to add the 390 long put, which is what I'm going to do here. And I'm going to make it $20 wide on the upside as well. So I got the 450, so I need to sell, I'm sorry, I need to buy the 470. Okay, there you go. So now I have an Iron Condor here, and this Iron Condor is on the call side 450, 470, and on the downside, so on the put side, is going to be 410, 390. Both of them are $20, okay? And I'm going to be doing that for $7. That's going to be my credit. So now I have a bit of a different different structure to my trade. Now my break-evens are going to be 402.97, 457.03. So the break-evens are closer to the at-the-money because I got less credit. The credit is 703, so $703 is the max profit. But the max loss in this case is not unlimited. It's only $2,000 minus the amount that I received as credit, so $703. So my max loss is the one that's going to drive my buying power reduction. I'm going to be margined for $2,000, but I'm going to receive $703. So altogether, we'd be talking about the same as having the max loss be my buying power reduction. Okay, so this is a big difference. We were talking about around $6,000, $7,000 for the Strangle. However, if the position starts moving against me, those 6,000 are going to change. They might be 7,000, 10,000, 12,000, because the broker has to make sure that I have the funds to cover a losing position. So they're going to start requiring more and more funds, more and more collateral. Okay, so what I'm going to do here, same thing. I'm going to send this to analyze. We're going to take a look visually. Okay, so what I'm going to do here, I don't care about that. This is June 20th, so that's good. Okay, so this is the Strangle. Okay, so the price is over here. This is where our short options are, 410 and 450, and altogether I'm getting 1222. Okay, so my max loss is unlimited. It can go higher in price, lower in profits arbitrarily. It could go and keep going, and I'm gonna have a huge loss. Okay, so it's unlimited in terms of losses. It's kind of limited on the downside because you are bound by zero. It can't go lower than zero, but on the upside is completely exposed. Okay, this is a Strangle. Okay, I can make 1223 and I can lose a lot, but the buying power reduction for this one is going to be basically what we saw, which was around $7,000. Okay, now let's analyze the Iron Condor here. $1,200 is what I'm getting as credit. Okay, for the Iron Condor is the same shorts, 410 and 450, but now I'm adding the long at 390 and the long at 470, which is capping my losses. So no matter how high it goes, my loss is always going to be limited to the width of the spreads minus the amount that I received as credit. Okay, so this is the advantage of having an Iron Condor versus a Strangle. Okay, my max profit is going to be $700. Notice how in this one I'm getting less, $700. Here I'm getting $1,223. So it's considerably less than the Strangle, but that's because I bought the wings, and with this I have peace of mind that that my losses are never going to be unlimited, and that I'm never going to wake up one day to a huge catastrophic loss. In this case, I'm protected on the upside and on the downside, and for that I'm paying a price, and the price is the price of the wings, which reduces my initial credit. Okay, so as you can see, these are the differences between a Strangle and Iron Condor. We are looking here at shorting both. So I'm short a Strangle and I'm short an Iron Condor. I'm selling something, receiving a credit, and then looking at buying to close for less than the credit that I received initially. You could also do the opposite and basically buy a Strangle and buy an Iron Condor, which is something similar. Now, if you buy it, what you're going to have is you're going to have the opposite. Now, your price is here. You want the price to go very low or very high. And in exchange for this, you're going to have unlimited profits. But if it starts not happening, so let's move time forward. So I'm going to simulate the passage of time. Here, this line, the purple line, is my profit and loss. I'm going to start losing money unless very quickly I move a lot. When you do the short version, you have the opposite. You see? You start right here, and as time passes, if nothing changes, you start making money, which is this line, okay? If you do the opposite one, if you buy it instead of sell it, then you want the stock to move, but every day that passes and it doesn't happen, you start losing money. And then one day maybe it's going to move a lot, and then you're going to make a lot of money, and you can make much more than you put in because your profits are pretty much unlimited. But this is the trade-off that you have. You have on the one hand, with a short strangle, you want things not to happen and you want time to pass. With the long strangle, you want things to happen either on the downside or on the upside, and time passing is your enemy. So these are mirror positions. Basically, the other side of the coin is buying a strangle. So whether you want to do one against or prefer one over the other is a matter of preference. In terms of traders who trade options for a long time, for the most part, the sell or the short version of the strangle is the one that's used the most. Okay, which is why I focused on that one. But I just wanted to mention that you can buy it as well. Same with the Iron Condor. Instead of selling the Iron Condor, you can buy it. And then what you want is you want the price to move a lot, but your profits are capped here on top and on the bottom. Okay, on the upside and on the downside, your profits are capped. You want, if you stay here, you're going to lose money because this line is going to keep moving. Okay. But if there's a day where the stock moves a lot, either to the upside or to the downside, you're going to start making money. So it's, again, the trade-off of buying or selling an Iron Condor or a Strangle. When traders mention that a certain strategy needs to be put on and there is no indication as to whether the strategy should be a short or a long version, if you only hear Strangle or Iron Condor, if somebody tells you put on a Strangle, put on an Iron Condor, or I put on a Strangle or put on an Iron Condor last night or whatever, then if there is no indication, then the trader is referring to the short version. If you don't mention it, if you just say a Strangle, for the most part, people refer to the short Strangle as just a Strangle, and same with an Iron Condor. If I tell you I put on an Iron Condor last night, then what that means is I sold an Iron Condor last night, I received the credit, and now I hope that IV goes down and that nothing happens, that the price doesn't move, and that time passes so that later on I can buy it to close for less than I received as a credit, and then I'm going to realize my profits. So I hope that this was interesting. This is one of the most important positions, and one that for many traders, myself included, the default position when you're hunting for trades is actually a Strangle. It's a Strangle. So you look for an underlying that has an elevated level of implied volatility. So it's inflated, so to speak, and you sell a Strangle. It's delta neutral at the beginning. And then you hope or you plan around the price not doing much and time passing so that you can collect your profits by buying to close later on. Now, an Iron Condor is also used by many traders, and this is because if you want to use a very expensive underlying, the buying power reduction for Strangle is going to be prohibitive, and you're going to have a lot of your portfolio tied up in a single position. You don't want that. So what you want is you want to manage your capital in a very smart way. So what you do is you switch from a Strangle to an Iron Condor, and that way you know that you're just gonna put down less money to maintain and to carry the position than you would if you were to pick a Strangle, for example. So Strangles, Iron Condors, very important positions, bread and butter for traders, for option traders. And I hope that this information is useful for you guys, and I know it will, because this is one of the most important positions. So I hope that this information is useful for you guys. I know it will, and thank you very much for your attention. Goodbye.